October 23rd, 2024. I wanted to talk a lot about, I'm going to get there because it's early in the day, but I wanted to talk a lot about bars 16, 17, and 18 today because I think these three bars really changed kind of the complexion of the day and gave traders a hint that it might be a bear trend day. Also, something to keep in mind, when you have a very tight opening range like we did here, sometimes those tight trading range opens have an increased chance of leading to some sort of trend day. So you can see we were near yesterday's low. I think context is really important here. So let's just look at a 15-minute chart. Hold on. So we'd been, the bar counter is making this messy, but we'd been basically in a trading range since over here, since this spike. So this whole thing had been a trading range and we broke below it today. And you can see we have a failed breakout below it and it looks like we're rallying back up into the area. And obviously, a lot of times when you get a failed breakout below a trading range and you get a reversal, the market tries to reverse and test the other side of the trading range, which would be, basically the all-time high. So that's something to keep in mind for tomorrow. But you have the thing to keep in mind mainly coming into the day is that we're at the bottom of a trading range. So the market is trying to break out below it. Bar one, a bull bar after a gap down. Good for the bulls, but a big tail on the top and a big tail on the bottom. So not quite as bullish as it could be. Had it been closing on its high, its potential low of the day, but really not all that great. Bar two is an inside bar and a little one short. It's low probability that it's the high of the day. Bears selling here would be taking a chance that we're going to get a second leg down from the gap down, which is not unlikely. We might get the second leg down, but the market might also go sideways for a little while first. So some traders would take the sell, but most traders would just probably rather wait. Buyers below two during three, so the low one short ends up finding buyers below during bar three. Probably going to get a little bit more sideways before we get any sort of breakout. Bar four, a bull bar, but really not all that great trading above three. Bulls are hoping three was the low of the day, but it's a bear bar, so really not a very good signal bar. Five, a bear bar, but probably buyers below four is the problem. So at this point, the bulls or the bears are hoping that we have first leg and then a pullback and a second leg, and that we're going to get some sort of trend resumption, or maybe a third push up and then trend resumption. And the bulls are hoping if we do get trend resumption for the bears, it's a final flag, that this was the final flag and that breakout below will fail and we'll end up getting a rally. Six, a bull bar, but basically just a doji bar. There's probably buyers below scaling in lower, and there's probably sellers above scaling in higher. So not really a very great bar to be doing anything. This to me just looks like a tight trading range. We're also reasonably far away from the moving average, and I don't want to be selling this type of price action this far from the moving average. So really not great to be doing anything. Seven, a bear bar closing near its low. It's possible we've seen the high of the day at this point and we're breaking out to the downside. However, it's still a tight trading range. So rather than selling below seven, I'd probably just rather wait and see what happens. Eight, a doji bar. So disappointing follow through. If you took the sell below seven, you were hoping this was the start of a big bear trend day and you got a doji bar as your follow through. It's really not very good. You were probably hoping to see a big follow through bar on bar eight, and this is what you got instead of that. Nine, you can see a small bull body, and it did rally a little bit during the bar. I think the reasoning for that is the bears who sold the close of seven are obviously disappointed in eight, and they're using the sell-off on nine to buy back their shorts, and that's what's causing the obviously the bounce on bar nine. 10, a big bear bar closing near its low. It's three pushes down, 5, 7, and 10. And if you look at 10, we're basically at the bottom of a trading range. We don't have a breakout below anything. So bears are hoping to get a breakout below the low of the day, below bar 8, and a lot of follow through. And bulls are hoping to disappoint the bears. And I think 11 is sufficiently disappointing. If I had sold below 10 and I saw 11, I would probably just get out of the trade. It's not good follow through. You were hoping to get a bigger bar, and instead you got a doji bar. So most traders do not want to sell below the doji bar. Additionally, 11 is unable to close below the bar 8 low. So it's in a way a failed breakout below the low. And sometimes when that happens, bears get desperate and buy back shorts pretty quickly because this could be a wedge. 1, pullback, 2, pullback, 3, and no breakout below the low. So a lot of traders get disappointed pretty quickly and buy back their shorts. And that's what causes the rally on bar 12 to close near its high. So 12, it's a good looking bull bar, but really what it is bears buying back shorts. So it's Bears giving up on this being the start of the big bear trend. They're hoping that 10 was going to be the start of their bear trend. They're disappointed. They're buying back shorts. That's causing the rally on 12. 13 is follow through, but I think it's just the remaining bears exiting. This is not an area to be looking to buy. We haven't been above the moving average yet today, and that's really important. You'll notice we spent the first 58 bars below the moving average today. The fact that, for me, once I see this, I'll get there. Hold on. 13 follow through, 14 an inside bar. It's a high one buy for the bulls. Am I buying above this high one? No, you're buying high in a trading range on a moving average. You haven't broken yet today. 15, a bull bar, disappointing follow through, I think, if you bought above 14. And then big failure at the moving average on 16. The bulls are hoping 11 is the low of the day. So if 11 is going to be the low of the day, then we need to get through the moving average. And 16 is a big failure at the moving average, and we don't get a close above the moving average. 16 is double top bear flag, 116. 40% chance you get a breakout below and a measured move down, something along those lines. 17 is a really important bar. If the bulls give up, the bulls who are buying for any reason, hoping 12 is the low of the day and that we're going to get a good bounce, they give up on 17. That's what causes the bar to be so big. Now we've tested the moving average and we can't get a close below it. There are times where you get a big gap down and the market just has to get to the moving average and then it trades above it and it turns into a normal trading range day. However, the fact that 16 was not able to close above the moving average is really important. And the fact that 17 following it is a giant bear bar is really important. So for me, when I see 16, 17, and let's say even 18 follow through, right? So 16, 17, 18 is a first leg down. Normally, you don't want to sell a first leg down at the bottom of a potential trading range. But the fact that we haven't gone above the moving average yet today is what makes this a good sell. If you take the short, I took the short and I ended up exiting in here because I don't trade. I don't hold always in usually. But the fact that, once you start to see this and we haven't been above the moving average yet today, you should immediately turn your brain off to buying. You're not buying. You're not buying any of these reversals. You're certainly not buying this reversal. You're certainly not buying this bar. You are not buying anything until we get above the moving average and get consecutive bull closes above the moving average. So on days like this, where we're sitting below the moving average, do not try and be the first trader who takes the buy that ends up rallying above the moving average. It's a losing strategy. It doesn't work. So just whenever you see, when we're 18, 20, 22 bars into the day, we haven't been above the moving average, or we're 18, 20, 22 bars into the day and we haven't been below the moving average, you should never be looking to trade counter trend. So that's also just another good thing to do on trading range days. Keep track, right? If you're on bar 40 on a trading range day and you've had 30 bars above the moving average and 10 bars below the moving average, we're probably going to go up. So that's something to just keep in mind, is the moving average is really, this specific moving average. You can use whatever moving average you want, but it's all about learning, getting to know your moving average. Each moving average is its own kind of individual person, almost in a way. And so if I put in 100 bar EMA on here, I wouldn't really know how to treat it. I wouldn't know how to trade it because I don't know that moving average. I haven't used it, but I have a lot of knowledge on the 20 EMA because I've used it for 5 years. And so I know it pretty well. So there's really no reason with this particular EMA, the 20 EMA, that you should be buying for any reason on this day up until bar 62. 18, like I said, 3 consecutive bear bars. We're probably going at least a little bit lower. 11 is not the low of the day. It's very unlikely. If 11 was going to be the low of the day, then 12 through 16, or 17 and 18 probably would not have happened. 19, a bull reversal. The bulls are hoping it's a higher low double bottom from 11 and 12, but it's probably not. 20, a bear bar closing near its low. Do you sell below 20? You can. You're now in sell to close, sell for any reason mode for sure. So it's a low one short for the bears. So you can take the short below 20. Follow through 21. Do you sell to close at 21? Yes and no. Yes, you can sell it because we haven't been above the moving average yet today, but we're not going to collapse. So we're not going to collapse below 21. So if you're taking the short, you have a wide stop and you're prepared to sit through a pullback. So if you sold to close at 21 and you did not hold through those 3 legs up, then you're probably not ready to take that kind of trade yet. 22, an inside bar, a low one short. Low ones generally lead to deeper corrections and then trend resumption. So it's not surprising we got a bit of a rally above bar 22 during bar 23 since it's a high one or a low one short. Sorry. So we traded above 22, sellers above 22 during 23. And then 24, another leg down. It's possibly 3 legs down, sell off to 18 to 22 and 24. So it's possible that is 3 legs down. However, it's going to lead to a minor reversal up. 25, a doji bar, probably disappointing follow through if you sold below 24. Not really quite great to put your stop above 23 yet. I'd probably still have a stop above 18 most likely. There should be sellers at the 21 high if we get there, but we shouldn't get there. Again, your whole premise for being short at this point is that we're not getting back to the moving average, or we're not going to close above the moving average. Another interesting thing is gaps, right? You have to have open gaps in order for there to be a successful trend day. And what did 21 do? It created an open gap with the bar 12 low, or 11 low, sorry. So the question everyone's asking right now is, are we going to get to the moving average, and are we going to close this gap? The fact that we didn't do either and then got a big bear bar closing, not quite near its low, but a big enough bear surprise that it's going to get a couple more legs down, this is a sign that we're going lower. 26, a bull bar, closing somewhat near its high, but again, I think it's just bears buying back shorts. Disappointing we didn't collapse below 24. 27, consecutive bull bars, good for the bulls, but I'm not really interested in buying the close of 27. Disappointment, 28, a low too short. Could you sell it? Maybe with a wide stop. Disappointing follow through, 29. So another doji bar, consecutive dojis, 28, 29. Again, a low too short, not really that great. And then a bull bar, 30. It's 3 pushes up. So 23, and then 27, and then 30. And the bulls, again, at this point, they're hoping that we get a breakout above the moving average and close the gap with the bar 11 low, and that this turns into a trading range day. Maybe they can get a midday reversal. But no one wants to buy yet if we haven't closed above the moving average. And then sure enough, we get a collapse on 31. So bears sold the close of 30, scared that some other bears might exit above 30. It's also a pretty easy way to get good risk reward, because if you sell the close of 30 and it doesn't trigger above 30 and we get something like we got on 31, the market could go a lot lower. So you might only be risking a point trying to make 20, 30, 40 points. So that's why a lot of algorithms will do that. And that's what causes 31. 32, a doji bar. So a bit disappointing follow through for 31 to get 32, the doji bar. However, it doesn't matter. I think, to be honest, the context is overwhelming. So you have to keep in mind that if you're still short, this gap is open, and that we shouldn't get above the moving average. So for you, any bar, any pullback should just be noise. You shouldn't really worry about it. And you should just keep your stop. And then when you get a lower high, you move your stop to the lower high. So once we have maybe 44, you pull your stop to the 41 high, and then you just ride the market all the way down, exit somewhere in here. 33, an inside bar, a bear bar closing near its low. It's a low one short. Let me grab a sip of water real quick. So again, low ones often lead to pullbacks, so not too positive we're going to collapse right below 33. Disappointing follow through, 34, a bull doji bar. 35, another bear bar closing near its low. Again, sell the close, sell for any reason. We do have a decent amount of doji bars, 31, 32, or sorry, 31, 32, 34 is what I meant to say, but not really too concerning. Again, the context is what you're trading here if you're shorting. 36, another bear bar, and then a reversal up. 37, it's a wedge. 8, 21, 37, but wedges constantly happen in bear trends. They don't really mean much. Also, technically, you got what you wanted if you bought the wedge, because what are you looking for in wedges in general? 2 legs sideways to up. But depending on context, those 2 legs can look very different. So, I can try and find an example of a better context wedge. Okay, this is fine. I'll illustrate my point. This looks like a couple legs in a trading range, right? We get this big reversal up and we're above the moving average and we're failing below the moving average. So this looks like 3 legs down, and 20 looks like the start of 2 legs sideways to up that could actually go somewhere. This, on the other hand, is a scalp at best on 37. You're looking for a second leg sideways to up, and you got it on 39 and 40, but it's just not a very good second leg sideways to up, because a lot of times in a bear trend, you're not going to get good bull moves because it's a bear trend. So 38, a disappointing follow through bar, but relatively expected. 39, sellers above 38. Again, I think a lot of traders are looking to exit. And then 40, a bull bar, but it's right at the moving average. Bears, they're selling the close of 30. They're going to sell the close of 40 as well. They're going to sell the bull bars closing near the moving average on a bear trend day when we haven't closed above the moving average yet today. And that causes the big outside down bar, 41. You could sell the close of 41, probably just put a stop above 41, to be honest. It's maybe not the highest probability to throw the stop there. But if we haven't been above the moving average yet today, the reality is if your stop above 41 gets run, we're probably going above the moving average. So it's not illogical to sell the close of 41, stop above. 42, the doji bar, so a bit disappointing. Probably sellers, probably in theory, buyers not too far below, but the context, I'm not interested in buying anything. 43, another bear bar closing near its low, sell the close. 44, another bear bar, sell the close. 45, another bear bar closing near its low, sell the close. The issue with 45 is that you're breaking out below the bear channel. We'd had a reasonably clear bear channel line, and we got a breakout below on 45. Some bears would argue that it's a wedge, 1, 2, 3, and we're getting a breakout below a wedge. So this is its own new breakout, but it's not super high probability to go all that far, considering the fact that we have a wedge. Considering the fact that we're very oversold, and this is making us even more oversold. But it's still, you can still sell the close of 45 and just get out if you get a bull bar or consecutive bull bars closing near their highs. 46, disappointment, a doji bar, but still follow through. Again, it's sell the close, sell for any reason until the bulls can prove that they're in control. 47, another another bear bar, but the tail on the bottom. So it's a little bit of a tight trading range, 46, 47, but doesn't really matter. 48, a bull bar, top of the tight trading range, and closing near its high, yes, but it'll need follow through if you want bears to exit. A lot of bears are going to be more interested in selling that close, which is exactly what happened on 49. Bear bar, but a large tail on the bottom. Still reasonable to be short. Consecutive bear bars 50, 49, 50 at the new low. Disappointment 51, but still, again, reasonable to hold short. No one's buying above 51. That's never going to go well. So probably sellers above. 52, consecutive bull bars, but no one's buying the close of 52. It looks like you're going to end up getting stopped out if you do that. 53, a bear bar closing near its low, sell the close. 54, sell the close. 55, sell the close. Again, getting climactic, right? So by the time you get 55, we are oversold and you are selling pretty low in the range, but it's still reasonable to do. And again, you just end up getting out, probably above 59 or 60. 56, a bull bar. Bears would probably exit above 56 if it doesn't trigger. You get a bear bar closing near its low 57. Why are they exiting above 56 but not up here? Because we have a new breakout and then another new breakout. So this was a bear channel, breakout below the bear channel, spike in channel, and then another breakout to the downside. We have so many breakouts, it's very climactic. So traders are looking to get out. Usually on a trend day like this, when you get the bounce, so a big bear trend, you're usually not going to get the bounce until bar like 50 or 60 or something. So when you start getting into this area and you're getting more and more climactic breakouts, traders get more and more concerned. So I believe I was on 57, doesn't trigger above 56, 58 consecutive bear bars, and bears buy back shorts causing 59. Again, I think the remainder of the bears are going to exit above 59 or 60, and that causes 61. 3 straight bull bars, 59, 60, 61. Really, really oversold. The market doesn't usually get, obviously it doesn't usually get this oversold. It only happens occasionally, but this is a pretty oversold move. And sometimes when that happens, you have to pay attention to the rally. 61 was a good looking bull bar, but bears have been selling the moving average all day, and they might sell the first close above the moving average as well, except for the fact that you get 62. 62, I think, changes things a little bit because you now have consecutive bull bars closing near their highs and one fully above the moving average and both closing above the moving average. Bears should not have allowed 62 to be such a strong close if we were going to get a gap bar and a sell-off. So 62 is your hint that these are not strong sells. There's probably buyers below these areas because why are the bears allowing consecutive bull bars closing near their highs above the moving average? Go back and look at, make a study and go look at, every moving average gap bar on trend days, and you'll find that usually you're not going to get consecutive strong bull bars and then a bear bar closing near its low and then it sells off. And if anything, the bulls who buy, if you get a big bear bar closing near its low, they'll exit. So where are we rallying to? The targets are the 48 high, but we're almost there. And then probably the bar 40 close. So up here, you could argue that the 43 high is a sell climax high, and that's a high. That's a target as well, but this area is also a target. 63, another bull bar. So 5 straight bull closes. We're going to go get a second leg, so we're probably going at least a little bit higher. 64, another bull bar. What do you need to exit if you're long? Probably consecutive bear bars closing near their lows would make most traders exit. Let's see, where was I? Sorry, I was looking ahead. So 64 is 6 straight bull bars. We're probably going at least a little bit higher. 63 and 64 do have tails on them, so we might not race straight up. We might go more sideways to up. 65, an inside bar, a bear bar closing near its low, probably buyers below. 66, a bull bar closing near its high. It's a high one buy for the bulls, but again, a lot of times traders, they prefer to buy below high ones instead of above high ones. So perfect example here, instead of buying above 66, a lot of traders bought below 66 for a second leg up from the move from 59 to 64, and we should be getting a bull channel. So the fact that the bulls were more interested in buying a pullback here tells you that it's a little bit more, a little bit less likely that we race straight up and a little bit more likely that we channel up. So 67, disappointing follow through if you bought above 66. Bear doji bar, but still always in long. I think 61 probably made it always in long, and 62 definitely made the market always in long for the first time all day. 68, another bull bar or another bear bar, probably sellers above, probably buyers below. 69, probably sellers not too far above, probably buyers not too far below. You know, you're getting to the point with 3 straight bear bars where you're risking bulls quickly giving up and we collapse back down to maybe the bar 58 high. I would watch the bar 58 high over the next couple of days. If we start to sell off tomorrow, this might be a target, because the bears who sell above 58, it's not a good idea, but the bears who do it and are relentlessly willing to scale in will probably make money. 70, a bull bar closing near its high, a surprise for the bulls. 71, disappointing follow through, but still always in long. 72, again, another bull bar. And 73, an inside bar, a high one, reasonable to buy above 73. And you're taking a chance we rally up into this area. And then we start to rally, get disappointment. So a lot of bulls will exit below 77, but it doesn't trigger rally 78. And then basically the end of the day. So a bear trend from the open. What were the trades for the day? I thought you could probably sell 17, 18. You could sell 20, theoretically 21, 22. You could sell below any bear bar closing near its low. You get a wedge pullback. You could sell the close 31, 34, 35, 33, 36, 41, 43, 44, 45, 50, 53, 54, 55, but getting late, and 57 again, but getting late. An exit above 59 or 60. Would I buy the close of 61? I probably wouldn't, just because I want to see consecutive bull bars above the moving average, but I did buy the close of 62. I thought that was fine. And then if you do that, you probably just hold for most of the rest of the day. There's no real reason to exit. You buy above 66 with a wider stop. You buy above 73, 74, 75, but getting late. For limit orders, I mean, I suppose you could have sold above 20. You could sell above any bear bar. Sell above 29. I mean, you could sell above any time the market, again, no closes above the moving average. You could sell above any time the market trades above another bar. I wouldn't do it over here, but once we start to do this, then I think you could sell above this, you could sell above that. Not great, but you could sell above this. Theoretically, you could sell above that, but it's better to sell above bear bars. You could sell above 47, sell above 51. Yeah. For the daily chart, so initially we started to sell off in the moving average, but obviously we found buyers. I think the Globex chart does a better job on the daily chart. So you can see we had tails, and then a dump, the downside. And usually what happens is it's one and then pull back, right? Because look at this day. They went down and then back up. And the next day went a little lower and then back up. And then the third day went down and then got a big failure. So it's basically a wedge and a failed breakout below. So what is tomorrow going to bring? I'm not really that sure, to be honest. Probably a trading range day. Sometimes when you sell off a little bit, remember that high that I highlighted? This high, the 58 high, it's possible that tomorrow, if we start to sell off, we test that 58 high and then it just becomes a big tail and we get a bull reversal bar. But if we do get a bull reversal bar, we're probably not going that much higher. But if we get any sort of bear close below the moving average, odds are it's going to be bought, because we've had basically 31 bars consecutively, but we haven't been below the moving average in a month, right? So it's been since September since we've been below the moving average. So if we get a bar below the moving average, bulls will probably buy it. If we get a bar below the moving average and then consecutive bear bars below the moving average, that could mean we're going to start testing the lower highs. 5,000 is pretty far, but I do think we're getting back there at some point. So look at this bear micro channel, not tested, right? So I don't know. I think at some point we're getting back here. I don't think we're done with 5,000. I don't know. We're probably going higher first. We're definitely going to 6,000 first, but the weekly chart, so traded below, but again, you have to expect buyers below this bar. But second reversal down, first reversal down, second reversal down, so possibly one more leg up and then a third reversal. The monthly chart becoming important. The bears definitely have a chance at creating a bear close. We're only 58.07 is the open of the month. So if the bears can get a bear bar closing near its low, possible the bulls exit below. Is it likely? No, but it's possible. Sometimes you'll get a bear bar closing near its low, and it's just the market trapping out the bulls before it rallies up to 6,000. But even if we do get any sort of bear close here, I would imagine the traders who sell, well, let's say a bear bar closing near its low, I would imagine the traders who sell and sell more higher will end up making money. All right, that is going to be it for today.